Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, OpenAI execs U-turn and David Sacks says no on a federal backstop to fund AI infrastructure. Markets react.
Plus, Musk's $1 trillion compensation package gets approved by Tesla investors with over 75% of votes cast in favor. We dig into the bold new promises.
And we break down more tech earnings with the CEOs of Affirm and DraftKings later this hour.
We go to these markets, though, in sell-off mode. Ed, on the day and on the week. Over the past 5 days, we've shed more than 4% in market capitalization. It is the worst week since April for the Nasdaq 100. And anxiety is really building when it comes to AI infrastructure and whether people have got the money. You're digging into it.
Yeah, here's a story that's played out driving markets. We begin with OpenAI and Wall Street's anxiety that followed fresh comments about potential government financing in the AI race. Speaking at the Wall Street Journal's tech conference this Wednesday, OpenAI CFO Sarah Friar called investors' attention after hinting at a potential government backstop for AI chip investments, a remark interpreted by some as Friar signaling OpenAI had federal guarantees for the costly infrastructure behind large AI models. David Sacks, the White House AI and crypto czar, seemed to be paying attention and posted on X Thursday, there will be no federal bailout for AI. The US has at least 5 major frontier model companies. If one fails, others will take its place. That, in turn, prompted OpenAI CEO Sam Altman to step in and clarify on X, writing, "We do not have or want government guarantees for OpenAI data centers," emphasizing that the company is not seeking a federal safety net. Let's get the latest. Bloomberg's AI editor, Seth Figerman, joins us now. Where do we stand? This is a multi-day story. Markets paid attention to it. What's the net result, at least from OpenAI's perspective?
Funny here, Ed, is that really the intention behind Sarah Friar's overall remarks at that event was to kind of calm people's nerves about what has felt like growing anxiety this week on the markets about AI spending. And instead, the takeaway was what felt like an off-the-cuff and vague remark that just heightened those concerns. I think where things currently stand is the company has repeated up and down that there's no discussions or plans for any kind of federal backstop. Instead, they're hinting at, well, maybe there's a role for government to invest in its own AI infrastructure that might somehow reduce some of the capital burdens here, or other indirect ways in which government could help the wider market. But suffice it to say, the message that she intended to deliver seems to have been completely lost.
Sam Altman went to great lengths to try and reverse, auto-correct in whatever way, make clear, and talked about maybe chip manufacturing. If they went into fabrication of chips, that might be an area that they lean on for government input. But what's interesting is we then look at that piece from Sam Altman saying that basically they've got $1.4 trillion of commitments. This is where the market's trying to wrap its head around. How can they afford that? He's saying they feel good about their prospects for revenue growth.
They've been on the defense about this a little bit in recent days, including on a recent podcast where Altman seemed taken off guard to even be asked that question. What he's trying to stress here is that our revenue is growing much faster than anyone has expected, on pace for $20 billion in annualized run rate, and that we expect that these commitments over a 7 or 8 year time period are more than achievable based on that revenue growth. That said, I think the overall market is looking at AI spending generally. Meta's shares had their worst 4-day rout since ChatGPT launched 3 years ago. Chip stocks are seeing a slump right now on valuation concerns. Michael Burry is getting out there, the one who predicted the housing bubble, and basically pointing out to our graphic on circular investments that center around OpenAI. Across the industry and the markets, there's just really heightened concern about how achievable and sustainable this spending is.
Bloomberg's Seth Figerman. Breaking it all down, we thank you so much. Happy weekend. Now, we're also watching shares of NVIDIA. That's after its CEO, Jensen Huang, said that the company isn't in active discussions to sell its Blackwell AI chips to Chinese firms, waving off that speculation that it's trying to engineer a return to the world's largest chip maker. Market, indeed. Huang explained that he merely intended to point out China's prowess in AI when he said, quote, "China will win the US-China AI race." Ed.
Let's look at shares of Tesla, down almost 4%. More than 75% of votes from shareholders were in favor approving the $1 trillion compensation package for Elon Musk that is over 10 years and has a very strong set of mandatory milestones he needs to achieve to unlock the comp but also the voting power that comes with it. Let's talk about that with Alexandra Mertz. She's the CEO of L&F Investor Services, but also a Tesla shareholder who discusses her views about Tesla on social media under the handle Tesla Boomer Mama. Mertz was present at the shareholder meeting last night, was also acknowledged by other shareholders who were reading out a proposal for Tesla to invest in XAI, which we'll get to. Alexandra, this paves a way for Elon Musk to take his stake in Tesla to 25% over the course of the 10 years. Could you just explain what the sentiment was like last night into this morning about how comfortable investors feel handing over that control to Elon Musk and the belief that you do or do not have that he can hit the milestones that have been set for him by the board?
Oh, I'm very confident that he will hit the milestones. He's shown us before what is possible. Nothing's never easy. But if you set goals to Elon, he's very competitive. He's obviously, in my views, the best executor there is on this planet, and he will execute. So that's not the question. The question is whether we would get sufficient retail and institutional shareholder support, and we should it. 75% is astoundingly high. It is higher than the previous compensation packages votes and revotes in 2018 and 2024. So this was a clear victory. I am so grateful for everybody who voted. I would like to see the 25% that voted against it, because how can you be against this if you are a shareholder? But that's another topic.
For example, we had the investment director of CalPERS on the show yesterday. CalPERS voted no. And the rationale was that in aggregate, they saw Elon Musk and board members already having 16% of the company. And the issue of key man risk. So if Musk does get there, right, and achieves 25% stake, what if something happens to him? Or what if something distracts him? XAI, SpaceX, for example. That was the concern they had. Why don't you share the concern?
Well, first of all, that's the same concern at 16% or 25%, right? So that CalPERS argument is just non-existent, even though it's a nice word salad. There is no doubt in my mind that that's what they try to do. It's not an issue about whether he, as a key man, is a risk to Tesla. He is. The same way he is the key person, he's also the key man risk. That is just a fact. And actually part of the structure of this compensation plan addresses that, as the last two tranches are linked to a succession plan, to a more formal succession plan than what is currently in place. So 16 or 25%, that's not a question. But at 25%, Elon is sufficiently strong to prevent activist shareholders trying to take over, bringing board members in that are not aligned with Tesla's mission. And I think that is the key point. Retail has always stood with Elon and has always been very active, knows what this company is about. So that is not the concern, but it is institutional funds that are in Tesla, despite the fact that they don't really like the company, don't understand the company, vote against interest of the company. And that can become stronger just by the pure mechanism of index funds, of political activism. And he wants to make sure that that can be prevented. And he's right. And the fact of being in Texas helps a lot, but him getting to 25% obviously is a good shield.
But that's exactly the worry, is that he does get the 25% control and can fend off activism that might be in some way trying to course correct, as others feel, outside of Tesla. Why is that? Well, you're saying it's a word salad, but for many, that's exactly the fear, that he has control over what he calls a robot army.
I understand that. I understand that there is a fear, but ask those activists what is their idea about Tesla, what is their idea about a better world. They never talk about that. They talk about the fact that they fear Elon is too powerful. They never talk about what Tesla is all about. I never hear a CalPERS or, God forbid, a Klaus Lewis, ISS, or the New York Comptroller talk about the mission of Tesla, talk about where Tesla is going. And, you know, I rather, as a shareholder, have Elon's have the keys to an army of bots than anybody else, including the 4 companies I just mentioned.
We'll put that to CalPERS. I feel that he, in many ways, was trying to articulate that they are about the long-term vision, whether it's about electric vehicles, whether it's about supporting the climate, whether it's about humanoid robots. They just don't think that perhaps another CEO couldn't achieve really significant, phenomenal growth for this business, even if it wasn't Elon Musk. Why is he alone the only person who could meet these milestones and drive Optimus to be on the moon, on Mars? I mean, that seemed to be the next area of growth. Was that what you wanted to hear, that we're going to have Optimus doing surgery, but also eventually going to Mars?
Yes, we should do. We should want to hear that. We also were absolutely excited thinking about chip manufacturing. I don't think that has really gotten through yet to the press, and I hope Bloomberg is going to talk about it. If Tesla goes into chip manufacturing, can you imagine? So I would like to ask Kalpers, show me one other CEO who did even half of what Elon has accomplished. If you show me one where you have the feeling that that person could do something even comparable, I'm ready to sit down and discuss it with him, but we've got to wait for a long time.
Right. Alexandra, I would push back a little bit because I wrote the story about Elon's comments from the earnings call about clarifying the Samsung-TSMC relationship. And I sent the headline last night about his comments on chip manufacturing. So I'm going to look into it. I need to ask you about XAI. You were in the room and were waiting on the 8K. What appeared to happen was Brendan Earhart, the corporate secretary, say there were more for votes than against, but a very large number of abstentions. And so they're basically reserving the right to wait, look at the non-binding proposal and go back to it. Is that your understanding of where things stand? And also just your reaction to it, because you were involved in the process of getting that proposal on the docket.
Yes, well, thank you very much. Yes, very good question. And as you point out, we haven't seen the 8K yet, so I don't have the underlying numbers, but I know exactly what happened. The board's recommendation was neutral. They did not give a recommendation. Lots of retail shareholders just follow blindly the board's recommendation. So by going after the board's recommendation, instead of voting none, they abstained. That is the logical way, and that's actually how it is automated. We had this issue with a Norwegian bank who gave their shareholders only a certain limited number of options to vote, and then the shareholders from Norway, which are very numerous in Tesla, could not vote for question 6. They were abstaining. So abstaining was also just a consequence of the way the proxy was laid out. And there was no better choice. It was a bad choice to not be able to give a guidance, but there was no other choice, because what the board is trying to do here, and we have to understand why that is to stay out of it until they get a clear mission from the shareholders. And why are they doing that? Well, because it is a conflicted situation. Elon is the key man in both XAI and Tesla, and as Solar City has shown us, it is always difficult to invest from one company A into a company B that are both led by the same key person. So the board tries to stay out of it until there is a clear mission. Now, we have to see the 8K numbers to understand whether this is now a clear call from shareholders to do it. If there were so many abstains, it may not be. But you also have to know that this shareholder proposal number 7 was always only advisory. It was never that this vote would have been an automatic investment. If the board now convenes that they want to invest, we will certainly have another shareholder vote on the exact proposal of investment, not just on the general idea.
Pushing us forward, and with great energy after what was a pretty extraordinary day at the annual general meeting yesterday. You were there and we saw all the dancing. Alexandra Merz, we love catching up with you. Thank you. Tesla shareholder known on social as Tesla Boomer Mama. Now coming up, Grand Theft Auto 6. It hits another bump in the road. We'll discuss why the latest title in the popular video game franchise is being delayed again. This is Bloomberg Tech. Shares of Take-Two having their worst day since February 2024, down almost 8%. Yesterday, the video game publisher pushed back the release of Grand Theft Auto 6 again, until November 2026. Let's talk through this with Bloomberg's games reporter Jason Schreier. Basically, it's going to be a year late now. Why this second pushback? What's going on with Rockstar?
Yeah, I mean, video games are complicated to make. This is going to be one of the biggest video games of all time. Will probably be the best-selling entertainment product of all time. And so the pressure is very high. Rockstar and Take-Two, they want this game to be as perfect as possible. They want it to hit 95 plus in Metacritic. That's the review score aggregator.
Right.
And yeah, I mean, these games need time.
I get that, wanting to hit 95 plus on Metacritic. What you just said about it probably being the biggest entertainment title to sell of all time. Go back to GTA 5 and explain the data that tells us this might be worth waiting for from Take-Two's perspective. They want to get this right from a sales point of view.
Yeah, there's a simple number here, which is that GTA 5, the last game in the series, which was released in 2013, has sold 220 million units, which, I mean, that's more. This one game alone has sold more than most franchises, Final Fantasy, Assassin's Creed. This makes it the second best-selling game of all time, only second to Minecraft, which was released on phone. So that's kind of a different playing field. So yeah, I mean, the stakes are very high. And again, I think that people tend to underestimate how difficult it is to make games, especially a game as big and ambitious and technologically impressive as this one. I mean, we've seen the trailers. We've seen what it looks like. It looks more realistic than any game we've ever seen. It's going to have a huge open world. The people at Rockstar are still working on it, still making new stuff for it, still building this world and fixing bugs. And Ed, you know well that games like Cyberpunk have come out in recent years and needed more time in the oven and came out too early, and that is just disastrous for the companies involved.
Right,
CD Projekt.
and they needed patch after patch, but I still went back and played it from the start after the patch. Bloomberg's Jason Schreier, thank you very much. Okay, sticking with gaming, a quick update in the Google versus Epic game case. A federal judge is withholding approval of Google's antitrust settlement with Epic Games. The company says it will improve the distribution and monetization of apps on Android phones. But US District Judge James Donato says he wants to look closer at the terms of a deal first to make sure it benefits consumers and boosts competition. Caro.
Meanwhile, we've got a lot still to digest. We speak with Affirm Holding CEO Max Levchin on the latest earnings results. Listen to Bloomberg Tech.
Shares of Affirm off session highs, up about 5%. At one point in the session, up almost 12%. The company posting a first quarter earnings beat, but really the focus is on it raising its 2026 forecast for gross merchandise volume, but it sets us up for an incredible fiscal 26. Joining us on set is Max Levchin, Affirm CEO. There's a lot of emphasis, at least from Bloomberg Intelligence in-house, on card and that driving volumes. But what we've learned across this earnings period in your domain is it's worth spending a minute on the underlying behaviors of your consumers that drove this growth in the quarter. What are you seeing?
So despite the vibe session we're seeing in the markets today in the last few days, Affirm's consumer is really healthy. They're shopping, they're buying, they're paying their bills. They're energized by the upcoming holidays. I think, frankly, the rumors of the American consumer's death are greatly exaggerated.
It's interesting because different segments of the technology sector tell different stories right now. Is there a specific product category or method of spending that is demonstrating that more than others?
I think we are quite unique in this sense. Affirm's brand, our promise really is use us when it matters to you because you'll have total control and great degree of transparency. And as the outside pressures, even the stories you read, weigh people down, it's easy to say, you know what, Affirm is at least the one thing that's going to keep me clear and in good control. And so we think people are coming to us a little bit more. Certainly we saw great demand for our recent 0-day promotion, but I think so far so good, at least in the Affirm consumer world.
The funny thing is, Max, sometimes the market likes to see use of Affirm or maybe more standard buy now, pay later offerings as the vibe session. Is that not the case?
We had more than 24 million active consumers last quarter. At this point, it's really dangerous to just say, oh, the Affirm consumer is doing X or Y. We have quite a number of segments. Folks that are using our 0% promotions are typically leaning into just frankly saving money and getting a great deal. Folks that favor longer terms to repay care a lot less about total cost, very much care about individual cash flow. And so depending on sort of which segment you look at, you'll see a slightly different behavior. I think the unifying factor is they're all getting a really clear deal. There are no late fees, there's no gimmicks, there's no gotchas, and that's the way they keep coming back to us.
And why you keep seeing growth merchandise volumes going up and to the right. What's interesting is your partnership model. Right. And it really works. Well, Amazon, Shopify, Apple, Costco. Where else do the partnerships make sense, Max?
You know, to be honest, everywhere. We just announced a really strong push into services. So for a long time, you would think of buy now, pay later as a thing you buy and pay over time. People buy more than things. They remodel their kitchens, they refurbish various parts of their house, and we just announced a great partnership with Service Titan, Vagara, a variety of other platforms. So we partner very widely because this model really works for any purchase. You know, anything from a couple $100 all the way out to thousands.
What about you leaning into the moment? There is a lot of competition and smaller scale, and many times you stand out because they're more dependent on late fees and other such charges. Would you do any M&A? Is this the environment in which you'd look to do that?
You know, I think our current growth tracks so well. I'm not sure I have a lot of time to consider M&A, but you know, never say never. Obviously, we're doing really well. The company is performing. I always found that building is my strong suit, but you know, who knows?
Max, this earnings season, we've had the opportunity to speak to the CEOs of Chime, Robinhood, SoFi, and now you. I appreciate there are differences in those companies, but in how people transact with money, what you all have in common is looking at varied products that you offer. What is your new product strategy going into 26? And do you have any sort of ideas about this generational wealth transfer that all the others are going on about at the moment?
You know, I think we are a payments company. First and foremost, our job is to be there, be available. You know, we talk a lot about there are many doors, digital and real world, where there are lots of little logos of payment systems. Our job is to be on every door, to be available, to make sure we are there to serve when people are buying goods or services. And so we're very, very focused on executing what we have. You know, 42% doesn't come easy, and we'll keep trying to hit really good growth. You know, I've learned the hard way not to pre-announce new products. We have all sorts of really exciting things we're cooking. You know, have me back and I'll announce it when it's ready to go.
Fair enough.
Beat and raise trajectory. That's how Bloomberg Intelligence sees it. Max Levchin, we appreciate it, Affirm CEO. Now coming up, we come back on today's big story of Elon Musk's $1 trillion pay package. From New York, from San Francisco, this is Bloomberg Tech.
Sixth and finally, on the 2025 CEO Performance Award to our founder and CEO, Elon Musk, with over 75% voting in favor. Approved.
That was Brandon Earhart reading the results of Tesla's shareholder vote yesterday, the company's corporate secretary and general counsel. And as we've been discussing, Musk's pay package worth potentially up to $1 trillion was approved. Today, the shares, however, are lower by 4%. Is that sell the news? Is there something in reaction to the vote itself? Not sure, Karen.
Let's get an investor take then. We bring in Gene Munster, managing partner at Deepwater Asset Management. Thrilled to have you on, so much to talk about. But look, 75% is a lot, but there also comes some significant milestones and also then talk of 50% growth in car production by the end of 2026. Can he make that, Gene?
No, the simple answer is that probably not, but that's what Elon did a master class is ultimately is throwing a ball out there that is difficult to achieve, but he has the wherewith to do that. And so that ball, you talked about the production piece, this 50%. He puts that target out there, but then he adds these kind of qualifiers that say that, yes, we can do it, but we can only move as fast as the slowest part of the production chain, that pipeline, to get them to build the whole capacity, to get them to build capacity. And separately, when he thinks about Optimus and what the potential is there, I mean, this is something that he outlined as a kind of a 5-year, 10-year plan, but it is ultimately something that, getting to 10 million robots a year, I just want to put that into perspective. 10 million a year, they're doing 2 million cars a year. And they really got moving in earnest on the car production in 2019. And so it's taken them 6 years to get to 2 million. These are huge targets. And Caroline, at the most basic level, he put big targets out there. That's what he does. And that's the mandate that investors gave him with this vote of this pay package, is they want these big targets out there, and he's delivering on that, whether it's the production or the commentary about Optimus.
Investors excited, your dog's excited, Gene. I'm interested about what, therefore, he has to do to keep up with the momentum now. Because, look, let's just ask you a basic question. Many were worried about a 25% ownership for Elon because of the control, not so much the $1 trillion pay package. It's more about that he's going to be controlling a robot army. Is that something you want to see, that generally society wants to see?
Well, that's what he wants, control. And the answer is no one wants an army of robots to be controlled by one person. But most 75% plus of Tesla investors want a company that's building that to be controlled by one person or controlled by Elon. And I think that that makes sense. Elon's been very clear that if he wants to build this army, if he wants to build this AI vision company, he doesn't want to be pushed out. He also left open the option for him to get pushed out, in his words, if I go insane. And so I think that's an important distinction too. He has control, but that doesn't mean that he's going to be at Tesla forever.
I think going back to basics is really critical here, Gene. So there's the mechanics of what happened. The vote passed, the package was approved, and then Elon Musk spoke afterwards. And he actually gave some information that relates directly to the milestones the company has set. So in the middle there, we're saying the board is tasking him over 10 years to deliver 20 million vehicles, right? He told us in his remarks that 2026 would see 50% annualized growth. That was something material, was it not?
We said 50% annualized growth, but then he put the caveat, if the supply chain can provide the components to get them to increase the capacity by that much.
Right.
It's a similar caveat that happens when he says we're going to have autonomy, full FSD approved in 1 to 2 months. That was his comments yesterday, pending regulatory approval. And so I'm a shareholder of Tesla. I think that this company is grossly undervalued. That may sound like it's out of touch with reality, that comment, but I think it's grossly undervalued. But I also am realistic about what goes on here. There's these targets that get put out there, but then there's these caveats that are out of his control that will be put on any sort of some of these really big targets.
You noted, as many have done, Musk's comments on silicon, and it was a throwaway comment, but the idea that Tesla might do its own fab. Are you taking that seriously?
So I'm not taking it seriously. I think that Elon wants to make a point, and the point is I think he's frustrated about what he is paying for silicon. If you look at all of his enterprises, SpaceX, XAI, Tesla, Neuralink, all those combined, the biggest line item on those outside of people is around silicon. I mean, he spends a ton of money on that. What he talked about here was having similar performance as Blackwell, NVIDIA's Blackwell GPU, at a 10% of the cost. He thinks that that's doable. And I just want to kind of put that to the test, is that kind of performance, that kind of cost performance is something that is, I think, unrealistic, at least for the next few years. It's the same reason why NVIDIA has been so bullish on their business, is that these customers would love to find an alternative, whether it's through custom silicon or through AMD, for example. But the reality is that NVIDIA still is the best bang for the buck when it comes to silicon, and that's a very expensive buck in this case. So I think that I generally don't think Tesla is going to or should do their own fab. I think $20 billion can be spent in much better places. He kind of threw the lifeline out there. Maybe we work through Intel has been a challenging road for Intel on the fab side.
Yes.
And building a fab, advanced fab, is really tough. These advanced nodes are very tough, and Intel's never shown they were competent in that.
Gene, broaden that out, therefore, because look, the whole market has a lot of anxiety on its shoulders right now around the build-out of generative AI infrastructure. Now, in particular, we saw Sam Altman trying to navigate what had become a bit of a explosion that the CFO had set off on Wednesday by saying maybe they'd look to some sort of government to support for their infrastructure spend. Sam Altman came out and said, look, the only way we'd want government support is perhaps if we became a fabricator of chips. But what do you make about the weight that is currently on this market about vindicating $1.4 trillion spending by a company that's making maybe 12 billion, call it maybe even 20 billion a year in terms of revenue?
So there is a switch that flipped since the end of October. I think it was like the 28th of October is when Jensen came out and said that NVIDIA is going to essentially beat the expectations by 15% plus over the next 5 quarters. He put out this $500 billion in Blackwell revenue, and that was a really big point. And then we had the hyperscalers, and then this conversation started to shift. There was a change in terms of how the AI investor is thinking about this. And the shift is this sense of like, wow, maybe this is just getting to be too much. We saw it happen with Meta stock. And then on top of that, Sarah Friar and the Sam Altman and the Goldman or the Wall Street Journal event, all of that kind of, I think you put all of this together and is all of a sudden this vortex of what's really going on here. Whether it's the government piece, whether it's the expectations that NVIDIA has about how much they're going to sell over the next few quarters, whether it's Meta saying how much they're going to spend in Amazon, it just feels like there's investors are now at a point where they're uncomfortable, that they don't believe that this ultimately is going to be prosperity. There's going to be prosperity around this investment. And so I think that's the shift we've seen. That's why I think we've seen sell-off in these companies. The fundamentals are rock solid. OpenAI doesn't need government support, there's no question, but there's a psychology piece to this trade, and I think it's just gotten softened by some of these conversations, just too many moving parts now for investors. That will settle down once they start to see the December quarter results and understand that, in fact, we are still early in this AI build-out.
Gene Munster, Managing Partner at Deepwater Asset Management. Great to have you back on the show. Thank you very much. Now, coming up, we're going to be joined by DraftKings CEO Jason Robins following the company's earnings and its new deal with Disney. More on that next. This is Bloomberg Tech. Welcome to our TV and radio audiences worldwide. We head back to earnings with DraftKings out with their results, cutting its revenue forecast for the full year. The company also out, though, with news that Disney signed a new multi-year deal to make the sports betting company the official betting site and odds provider for the ESPN Sports Network. Let's bring in DraftKings CEO Jason Robins. It's an interesting partnership, and I think that's where we should start. How much does this move the needle for you? You know, we've talked in the past on this program, Jason, with you about the integration of the live sports event and the broadcast with the betting activity. Your big picture goal with this deal?
Well, first of all, ESPN is a iconic brand. It's by far the biggest name in sports in the United States, and they have an incredible portfolio, an unmatched portfolio of sports content, influencers, talent. So it's really, for us, just the greatest partner you can have when you're in the space we're in. And Jimmy Pitaro, who runs it, really understands and I think values the sports betting space and understands that the customer overlap is high, and it's important that they engage their customers by being partnered with somebody like DraftKings. So really excited to embark on it. We've been partners with them many times in the past, so it's familiar territory. We know all the people there, and we're looking forward to working together. And you add that to our deals with NBC Universal and Amazon and others. We have an unmatched, I think, presence across the sports landscape over the next several years.
Prediction markets. Wednesday night, we were with Robin Hood at their in-person earnings call. That was wacky. Don't know if you consider that. But the month of October, massive volumes for them. You're being super thoughtful about predictions. I understand that, and you have a clear strategy. My question has always been how much a growth in a nascent predictions market cannibalizes other offerings that you have.
I think very little. If you look at the UK, for example, exchange-based betting is about 5% of the total pie. So, that's probably about right. And I think a lot of it is largely incremental because there are market makers and others that are not present on traditional sports books that generate a lot of the volume. So I think it's very much an incremental opportunity for us, and that's why we're so excited about it. We acquired Railbird, and we're also looking to, enter the market sometime in the next couple months.
What's interesting, Jason, is investors, analysts out there called out on the actual earnings script, talking about how marketing expenses, higher sales expenses, did eat into the results, and they call them also some ugly outcomes when it comes to the sports games. For that, you can't control. But what about the expenses you're going to have on the predictions markets?
Well, we do plan to make some investment there. We mentioned this on the call that we're going to be more, I think, conservative in terms of the paybacks we're looking for, just given how nascent a space it is and the fact that it's unclear kind of how this will all play out. But we are going to make some investment there. First, of course, in getting a product developed and making sure that that's the best in class. You can't win. And we've always said this product is the most important thing. You can't win if you don't have a great product. And then, assuming that the numbers check out, we'll spend marketing accordingly. We're going to be very data-driven like we always are on everything. We'll test into it. But we did want to make sure, as we guided, that we were thoughtful about giving the team some space to be able to accelerate spend if the numbers look good.
And therefore, the guide did pull back rather than uplift going forward, Jason. But you say it's conservative. You talk about an incremental opportunity from predictions. And I'm really interested as to how you make sure this doesn't cannibalize what you already have out there. You've talked a lot about how this might actually make more states accessible to sports betting, because at the moment you can get 50 states with this predictions market, but you've got 25 at the moment for your offering, and you're about to have, and you also have DC, and then you're adding Missouri.
Yeah, I think you're exactly right that this will hopefully lead more states to decide that they might as well legalize sports betting. I think predictions are a powerful talking point for that because, it's same as the illegal market, same as anything, but in this case it's regulated. But the bottom line is it's activity that's already happening in the state at some level that they are not directly benefiting from and regulating. So I do think that'll motivate some states. But for us, really, the cannibalization thing isn't a huge concern. We haven't seen that happen, not just here, but as I mentioned, overseas, where there's long established, it's not a brand new thing like it is here. There's been predictions and sports exchanges around for decades in the UK, for example. So we feel like there's pretty good data out there to show that head-to-head, the traditional sports betting product is a much far superior product for customers.
Jason, you said that this is the most bullish you've ever felt about the company's future. What are the underlying trends, data points, behaviors of your customers that give you that conviction? And why do you have it now that you didn't have previously?
Well, I think if you take a step back, it really starts with the progress that we've made over the last few years and the position we put ourselves in. Remember, 2 years ago, we weren't even profitable. 3 years ago, we had nearly $1 billion adjusted EBITDA loss. At that point, we were getting killed in the market because people thought we were going to run out of money and go out of business. We really buckled down. We grew revenues. We managed costs. And, just a few years later, we've had over $1.5 billion swing. So I think that shows that we are in a great position. But also, more importantly, now we're in a position to play offense. We are profitable. We have scale. We have the best product in the market. We have the absolute best partnerships and presence across the media landscape. We're about to launch sports predictions, which I believe represents a huge incremental opportunity for us. So a lot of really exciting things going on. And the only real negative on the quarter was the sport outcomes. I think all the hysteria over predictions is kind of nonsense. But the really only negative sport outcomes, but that's a temporary thing. That's not something that has anything to do with the fundamentals of the business.
DraftKings CEO, Jason Robins, thank you very much. Caroline.
Well, it's time now for Talking Tech, Ed. First up, Bitcoin. Well, it's fallen as much as 12% so far this week, on track for its worst weekly performance since all the way back in March. This in spite of President Trump's push to cement the US as the world's crypto epicenter. The market value of digital assets is now lower than when he took office. Plus China, well, it's allowing Dutch chipmaker Nexperia to export again from its operations in the country. This sets the stage for the Netherlands government to kind of back down and suspend its powers over the Chinese-owned company after a conflict that had threatened to disrupt global automotive production. And Apple's streaming service, well, it went down briefly for some users last night, shortly after the debut of the widely anticipated Pluribus. It's a new series from the creator of Breaking Bad. Look, this came at a bad time for Apple, which billed Pluribus as one of the major exclusive attractions. Ed.
Okay, coming up, we're going to speak with LTK president and co-founder Amber Vance-Box on the state of the consumer heading into this holiday shopping season. More of that conversation. This is Bloomberg Tech.
Look, we're at a time when consumers are more cost-conscious than ever. Brands, well, they're racing to meet them where they actually shop. Creator commerce platform LTK is expanding to include brand profiles, giving companies a new way to connect directly with value-driven shoppers within the creator community. For more, Amber Vance-Box, LTK co-founder, joins us now. It's really interesting because you have, 40 million monthly users globally on LTK. But they come because their creators, their favorite creator is there telling them, advising them on what they could purchase. Why is therefore Nike putting itself there as a brand individually?
You know, LTK is the single largest creator commerce platform. We have 30% of Gen Z and millennial women in the US using the platform. They're spending every 60 seconds, let's see, they're going, I think 60 people shopping every second. They're buying $11,000 worth of product every single minute. That's $6 billion a year. That's the equivalent of an Eras tour every single quarter. There's a lot of demand here, and that's only growing by $1 billion since 2024. You're seeing that consumers are rotating their trust directly into creators. That creator trust is up over 20% year over year. And brands want to have more opportunity to reach their customer on the platform where they are today. So just this week, we've had brands like you mentioned, whether it's Nike, Target, in the beauty category, Ulta, Sephora, Tarte, on the sport and athletic. It's Aloe, it's Nike, it's Adidas. Huge global brands launching their presence on the LTK social app to be able to meet creators and their audiences in a high trust environment that's so unique right now.
So what are they actually doing? I went onto the Nike offering, for example, and the moment it looks like they're getting creator content and sort of putting it onto their own landing page. How will they differentiate, do you think, going forward?
Yeah, so this is a whole new experience. This doesn't exist anywhere else. What we've done is we've launched a platform where these brands can come in and see all the content that's being written about them on the LTK platform. So that's been about 7 million pieces of original content just on the LTK platform alone from these creators year over year. So for example, Nike would come in, they see all the content written about them. They can curate for their audience, their favorite creators and the best content, talking about the products that they love. So if I'm a Nike fan, not only can I go through my favorite creators to find that product, but I can just search Nike, follow Nike, and see the things that they are curating. So brands are not creating the content on LTK. It's still creator driven, but they are able to curate it, which is giving their audience really another path to discovery on the LTK app. We found that 1 in 5 searches has a brand name. So people might be looking for like Nike running shoes. Maybe they're looking for, Abercrombie denim. They're looking for a Christmas tree from Target. We see that happening 1 in 5 times. And so this gives our brands the opportunity to have a little bit more influence over the curation of what that customer ultimately sees. By following that brand, it takes a little further, because what's unique on LTK is when you follow someone, it actually means something. Right. Our following feed means that you get to choose that content that shows up, and they want to meet their customers every day. That's a really important part of building community. It's something that is unique to LTK given the age of AI and algorithms.
Amber, very quickly, we had 30 seconds. You have rich data about behaviors in September and October. Is the consumer healthy through your data?
They are. We're seeing that they're spending average order values up 7% year over year on LTK. They're spending almost $1 billion more this year than they did last year. The biggest shift on the consumer side is that they are expecting for out-of-stock products. So we saw search for gifting go up over 300% in September. More than half of those in our consumer study said they expect for creators to help them source alternative products. This is a huge shift because last year it was all about price. This year it's all about in-stock. We're excited to help our brands navigate this through our all-new, all-in-one creator platform that's completely free for brands that we've just launched, where they're paying for success, not access. And so bring it all together for them this year.
Amber Vance-Box, LTK co-founder, thank you very much. Sadly, that does it for the edition of Bloomberg Tech. Check out the Pod Caro. You know where to find it. Happy Friday. This is Bloomberg Tech.